5 days. That is the entire window I want you to lock into your head before another word leaves my mouth tonight. 5 trading days from this moment, on the 15th of April, 2026, the Silver Institute and Metals Focus are scheduled to release the World Silver Survey 2026, which is the single most authoritative annual accounting of global silver supply and global silver demand published anywhere on the planet. 5 days. And the preliminary figures that the Silver Institute has already put on the public record in their February 2026 market outlook are pointing toward a sixth consecutive structural deficit year of approximately 67 million ounces, with mine production penciled at approximately 820 million ounces against total demand that the Institute itself admits will once again outstrip total supply for the sixth calendar year in an unbroken sequence. Sixth year. Read that sentence twice and ask yourself what kind of supposedly functional global commodity market produces 6 consecutive years of structural undersupply and continues to print a screen price that is currently sitting at $77.33 per ounce as of the close of trading on the 9th of April 2026 on the JM Bullion live spot tape. This is OG John AG, and tonight I am not going to walk you through the same Shanghai inventory story or the same London bailout story that the rest of the silver community has already chewed into pulp. Tonight I am taking you somewhere the financial press has refused to go, which is the production side of the silver equation, the mine gate, the cartel-controlled districts of Zacatecas and Chihuahua, the Indian customs houses absorbing physical metal at premiums that have not been seen in the modern history of the Mumbai bullion trade, and the single most underreported corporate guidance cut from the largest primary silver producer in the world. Subscribe before you scroll, because the next 60 minutes are going to put 6 brand new stress fractures in front of you that the mainstream silver narrative has not yet woven into a single coherent picture. And the picture is uglier than anything the desks have been willing to admit on a public conference call. Begin with the corporate filing that almost nobody on retail finance television bothered to read carefully when it crossed the wires on the 28th of January, 2026. Fresnillo Public Limited Company, the London-listed Mexican operator that is the largest primary silver producer in the entire world, published its fourth quarter 2025 production report on that date and quietly cut its silver production guidance for the calendar year 2026 from a previously published range of 45 to 51 million ounces down to a new range of 42 to 46.5 million ounces. Read those numbers slowly. The world's largest primary silver miner has just told its shareholders in a regulatory filing that the upper bound of its production capacity for the current calendar year has been reduced by approximately 4.5 million ounces, and the lower bound has been reduced by approximately 3 million ounces. The reason cited inside the filing is operational phasing and a forced shift toward narrower mineral veins inside the existing operational footprint, which is corporate language for the geological reality that the high-grade ore is running out, and the next layer of recoverable metal sits inside thinner, more expensive, more difficult mining intervals. The full year 2025 reported figure was approximately 53.8 million ounces of silver. The midpoint of the new 2026 guidance is approximately 44.25 million ounces. That is a year-over-year production decline of approximately 9.5 million ounces from a single producer who alone accounts for a meaningful percentage of global primary silver supply, and the financial press treated the announcement as a routine operational update rather than the structural supply event it actually represents. Now stay with me, because the second mine-side fracture is the one that the silver community has been actively avoiding for political reasons, and I'm going to put it on the record tonight, regardless of how uncomfortable the framing feels. On the 22nd of February 2026, the Mexican military completed an operation that resulted in the death of Nemesio Oseguera Cervantes, the leader known publicly as El Mencho, who was the head of the cartel Jalisco Nueva Generación, the single most powerful organized crime syndicate operating across the silver mining districts of central and northern Mexico. The death of a hierarchical cartel leader does not produce stability. The death of a hierarchical cartel leader produces fragmentation, and fragmentation in the Mexican mining belt produces a wave of localized extortion, hijacked concentrate trucks, kidnapping of mine personnel, and forced shutdowns of operations that previously enjoyed a stable, if illegal, accommodation with a single dominant local power. The proof of this dynamic is not theoretical. In late January 2026, 10 employees of Vizsla Silver Corporation, a Canadian-listed silver explorer with operations in northern Mexico, were kidnapped from a project site, and their bodies were recovered shortly afterward. 10 silver mine workers killed inside one operational incident in a single quarter. The industry response has been to quietly accelerate capital flight away from Mexican jurisdictions and into Tier 1 safer mining geographies inside the United States, Canada, and Australia. Hecla Mining publicly committed approximately $55 million to an exploration blitz outside of the high-risk Mexican corridor inside the same quarter. Pan American Silver, with deep historical roots in Chihuahua, completed its acquisition of Mag Silver Corporation in order to consolidate its 44% joint venture interest in the Juanicipio mine in Zacatecas, a defensive consolidation that telegraphs exactly which way the institutional money is positioning around Mexican country risk. The mathematical consequence of these two fractures, the Fresnillo guidance cut and the cartel-driven operational disruption across the Mexican silver belt, is that Mexico, which the Silver Institute has historically expected to deliver approximately 186 million ounces of primary silver supply into the global pool in 2025, is now facing a calendar year 2026 in which the entire upside scenario from Mexico is at minimum capped and at maximum vulnerable to a multi-quarter contraction event that no current Silver Institute forecast has yet incorporated. Mexico is approximately 1/4 of total global primary silver production. A meaningful contraction inside the Mexican production base is mathematically equivalent to a 1 to 2% contraction in total global silver mine output for an asset class that is already running a 6th consecutive structural deficit. There is no slack in the system to absorb that contraction without further drawdowns of above-ground inventory. Stay with me because the next number explains why the inventory drawdown is no longer a Shanghai story or a London story, but is now an Indian story. Now to India, because the Indian physical silver market is the layer of the global silver picture that the Western financial press has consistently underreported, and that the Indian customs data is now telegraphing in language that no honest analyst can ignore. In the single month of October 2025, the Indian silver import bill reached approximately 2.7 billion United States dollars, which is one of the largest single-month silver import figures recorded in the history of the Indian customs system, and which arrived inside a calendar period when the global spot price was already pressing toward record territory. $2.7 billion of silver absorbed into a single national market in 30 days. During the same October period, the implied premium on multi-commodity exchange of India silver futures over international spot briefly exceeded 12% on an intraday basis, which is the highest MCX premium in the modern history of the contract, and which translated directly into Indian retail bar and coin prices that pushed Indian household silver demand into a defensive accumulation mode that the international screen has not properly priced, 12%. For comparison, the normal MCX premium structure typically sits inside a corridor of 1 to 3% on an annualized basis. A 12% premium is the visible price of an Indian physical bullion buyer willing to pay almost an eighth above the international screen simply to lock in domestic delivery, and the premium did not collapse afterward. The Indian government, in direct response to the surge in physical demand and the abuse of jewelry import loopholes through Thailand and other ASEAN routing channels, formally restricted the import of unstudded silver jewelry into the Indian customs territory until the 31st of March 2026, requiring Directorate General of Foreign Trade licenses for all such imports and effectively closing the back door through which traders had been bringing silver into the country at the lower jewelry duty schedule. The Indian customs duty on bullion silver was reduced from 15% to 6% in the July 2024 union budget specifically to support the domestic solar manufacturing sector, which means India is now importing physical silver at a structurally lower duty cost than at any time in the previous decade, and the result is that Indian physical demand is structurally elevated against a global supply pool that is structurally contracting. Read those two facts together. The duty was cut, the demand surged, the premium spiked, the jewelry loophole was closed, and the price you are watching on your screen tonight is reflecting exactly none of that physical absorption. Now to the ETP layer, because the exchange-traded product holdings are the part of the silver story where the institutional positioning is being telegraphed to anybody willing to read the Metals Focus data tape. According to the Silver Institute report referencing the Metals Focus November 2025 presentation at the annual Silver Industry Dinner in New York, total exchange-traded product holdings of physical silver across all global silver-backed funds grew by approximately 187 million ounces inside the calendar year 2025, generating a year-to-date inflow rate of approximately 18% on the global ETP base. Total ETP holdings as of early 2026 are estimated at approximately 1,310 million ounces. Now read this next sentence very carefully because it is the line item that nobody in the mainstream silver press will put on a chyron. Approximately half of the total global silver-backed exchange-traded product holdings are physically vaulted inside the London market, which means that approximately 655 million ounces of physical silver, give or take, is sitting inside the same vault perimeter that experienced the documented liquidity squeeze of October 2025 and the lease rate spike that briefly ran above 30 times the normal historical level during the most acute phase of the squeeze. 30 times. The London ETP concentration is the single largest hidden vulnerability inside the global silver pool because the metal is legally encumbered by fund warrants and is therefore unavailable to satisfy cash market settlement obligations. But it is also physically located inside the same vault complex, whose deliverable free float is the smallest fraction of the headline number. The structural setup is a single jurisdiction concentration risk that does not exist in any comparable form inside the gold market, and the institutional analysts who track the data have been raising the warning flag in language that is increasingly difficult to misinterpret. This is the bearish counter-argument section, and I am going to give it to you with the same hard honesty I demand from anybody pitching me a position. The all-in sustaining cost for primary silver miners in the first half of 2025 fell to approximately $13 per ounce, which is the lowest reading since the first half of 2022, and which leaves the average primary silver producer with a margin of approximately $64 per ounce against the current spot, which is the largest dollar margin in the modern history of silver mining. A $64 margin per ounce is the kind of profitability signal that historically pulls forward marginal supply, accelerates exploration capital, restarts dormant mines, and triggers a multi-year supply response that eventually closes a structural deficit. The Silver Institute itself is forecasting that total global silver output for 2026 will rise by approximately 1.5% to 1.05 billion ounces, the highest reading in a decade, with primary mine production rising by approximately 1% to 820 million ounces and physical investment demand simultaneously projected to rise by 20% to 227 million ounces. CoinCodec's algorithmic models are projecting a near-term decline of approximately 4.89% over the next 7 trading days, with a target of approximately $69.35 by the 13th of April 2026, and a year-end target of approximately $78.16 that sits barely above the current spot. Bank of America has set a 12-month silver price target of approximately $65 per ounce, which is meaningfully below the current spot, while BNP Paribas has set a late 2026 target of approximately $100 per ounce, and the JP Morgan Commodities desk is positioned somewhere in the middle of that range, with a published view that is closer to the conservative side of the consensus. 3 of the largest commodity research desks in the Western banking system are publishing one-year price forecasts that diverge by more than 50% from each other, and that divergence is the single clearest evidence that the silver market is now operating without a stable institutional anchor. The most honest version of the bearish case is that the photovoltaic silver loading reduction story is real and is finally beginning to materialize inside the actual fabrication data. Silver use in photovoltaic cells grew from approximately 11% of total industrial silver demand in 2014 to approximately 29% of total industrial silver demand in 2024, but the per-cell silver loading has been falling year over year as Chinese solar manufacturers aggressively engineer the metal content downward to protect their margin structure against the rising silver price. The Silver Institute is projecting that total industrial silver fabrication in 2026 will decline by approximately 2% to around 650 million ounces, which would mark a 4-year low in industrial demand, and which is being driven primarily by the photovoltaic loading reduction. If the photovoltaic substitution accelerates faster than the supply-side contracts, the structural deficit narrative compresses inside a window shorter than the bull case requires, and the price action between now and the end of 2026 could be choppier and lower than the most aggressive long positions are currently anticipating. Stay with me, because the data point that resolves the bullish-bearish dispute in favor of the structural fracture interpretation is the United States Geological Survey Critical Minerals filing for 2025, which formally classifies the United States as approximately 64% import reliant on physical silver for domestic industrial consumption, 64%. The largest industrial economy in the Western world is now structurally dependent on foreign supply for almost 2/3 of its total silver consumption. At a moment when the largest foreign supplier, Mexico, is facing a documented cartel-driven security crisis and a forced production guidance cut from its largest single producer, at a moment when the second largest foreign supplier base inside Asia is operating under Chinese export restrictions that took effect from the 1st of January 2026, at a moment when Indian physical absorption is running at multi-decade record levels, at a moment when global ETP holdings are concentrated by approximately 50% inside a single London vault complex with documented liquidity stress, and at a moment when the world's largest primary silver producer has just guided down its production by approximately 9.5 million ounces year over year. Read those facts together, and the only honest conclusion is that the United States industrial silver supply chain is operating with zero margin for additional disruption, and the next disruption is not a question of whether but a question of when. Here is the 9th of April 2026 silver picture in the format you can write down and verify against any primary source. Spot silver, $77.33 per ounce as of the JM Bullion live spot tape on the 9th of April. Iran ceasefire window, 2 weeks under a 10-point negotiation framework with the Strait of Hormuz, reopened to coordinated transit. Fresnillo 2026 silver production guidance, 42 to 46.5 million ounces, revised down from 45 to 51 million ounces. Fresnillo full year 2025 reported silver production approximately 53.8 million ounces, implied year-over-year production decline at the midpoint, approximately 9.5 million ounces. Endeavor Silver Corporation first quarter 2026 silver production, approximately 1,875,000 ounces. Vizsla Silver Corporation kidnapping and casualty incident, 10 workers in late January 2026. El Mencho killed by Mexican military forces, 22nd of February 2026. Pan American Silver acquisition of IMAG Silver Corporation completed for the 44% Juanicipio joint venture interest in Zacatecas. Hecla Mining defensive exploration commitment outside Mexico, approximately 55 million United States dollars. Silver Institute 2026 structural deficit forecast, approximately 67 million ounces. Total global silver supply forecast for 2026, approximately 1.05 billion ounces. Mine production forecast, approximately 820 million ounces. Physical investment demand forecast, approximately 227 million ounces, up approximately 20% year over year. Total global ETP silver holdings, approximately 1,310 million ounces, with approximately 50% vaulted inside the London market. Silver Institute calendar year 2025 ETP inflow figure, approximately 187 million ounces. India October 2025 silver import bill, approximately 2.7 billion United States dollars. India MCX intraday premium peak in October 2025, approximately 12% over international spot. India unstudded silver jewelry import restriction in force until the 31st of March 2026. India bullion silver customs duty, 6% since the July 2024 union budget. United States Geological Survey silver import reliance classification, approximately 64% of domestic industrial consumption. Bank of America, 12-month silver price target, approximately $65 per ounce. BNP Paribas, late 2026 silver price target, approximately $100 per ounce. CoinCodex 7-day forecast, decline of approximately 4.89% to approximately $69.35 by the 13th of April 2026. Average primary silver miner all-in sustaining cost, first half 2025, approximately $13 per ounce. Implied current dollar margin per ounce against spot, approximately $64 per ounce. World Silver Survey 2026 scheduled release date, the 15th of April 2026. 5 days. The single most authoritative annual silver report on the planet is going to be published 5 trading days from this very moment. And the preliminary figures the Silver Institute has already telegraphed in its February outlook are pointing toward a 6th consecutive deficit year against a supply base that is being actively contracted by cartel violence, corporate guidance cuts, Chinese export restrictions, Indian physical absorption, and London vault concentration. Every single one of those data points can be cross-referenced against a primary regulatory filing, a corporate production report, a customs database, a Silver Institute publication, or an on-the-record analyst note from a major bank trading desk. None of this requires a conspiracy theory. It requires only that you read the filings, the production reports, and the customs data instead of the morning television talking points. And when you read all of it together, the only honest conclusion is that the silver market is sitting on top of a synchronized supply contraction event that has no analog in the modern history of the metal, while the screen price is being painted across a $40 trading range that the financial press is calling consolidation. If you watched all the way to this sentence, you are inside the small fraction of silver investors who actually do the homework. You did not skim. You did not let the Iran ceasefire headline lull you into thinking that the supply side was somehow stable. You weighed the bearish photovoltaic substitution case against the documented mine side contraction, the cartel-driven operational risk, the Indian physical absorption, the London ETP concentration, and the United States import dependency, and you notice that the people running the warehouses, the people running the customs houses, and the people running the mines are now looking at a reality map that the people running the screen price have not yet acknowledged. The gap between those reality maps is the entire trade. Hit the like button if this content gave you something the financial news cycle did not. Share this video with one person you know who is still getting their silver analysis from desks that missed the Fresnillo guidance cut and the Mexican cartel fragmentation story. Subscribe to this channel and ring the notification bell because in 5 trading days, the World Silver Survey 2026 will be published in full, and I will be back on this desk inside hours of the release to walk through every line of the new figures before any mainstream outlet figures out what they mean for the metal in your hand. Drop OG John AG 2.0 in the comments below, not because the algorithm cares about those 4 words, but because every time a new viewer sees them repeated, they understand instantly that this community is built on filings, on customs databases, on production reports, and on the slow, patient work of cross-referencing primary sources, never on the noise of the next television soundbite. The screen price is the lagging indicator. The mine guidance, the customs data, the cartel map, and the World Silver Survey are the leading ones. Watch all 4. Trust the second set. Invest with logic, never with noise. OG out.